All right, hello and welcome. Today, we're going to jump into a really unique corner of the financial world and talk about something called a Tier 2 capital bond. Now, this is an investment that doesn't really fit into the usual boxes, and honestly, that's what makes it so fascinating. So let me ask you this. Have you ever been in this exact spot? You're looking at your portfolio and thinking, man, I want to earn more than what a typical bond is offering, but I'm just not ready for the roller coaster ride of the stock market. If that sounds familiar, well, you're going to want to stick around. So let's kick things off by digging into why we call this an in-between investment. We're on the hunt for that sweet spot, right? That middle ground that tries to give us the best of both worlds. And look, that is really the key here. This isn't your plain vanilla corporate bond, and it's definitely not a share of stock. It kind of carves out its own little niche in the investment universe. So what exactly is it? Okay, let's dive into this. We're going to break down what a Tier 2 bond actually is. And a great way to think about it is as a crucial part of a bank's own financial safety net. So at its most basic level, a Tier 2 bond is a special kind of debt that banks issue. But its main job isn't just to raise money for day-to-day business. No, its primary purpose is to act as a shock absorber. If the bank gets into serious financial trouble, it can use the value of these bonds to soak up the losses. It's all about making sure the bank is strong enough to survive a crisis and, to keep the regulators happy. Now let's look at what makes these tick. There are a few key things here, but I want you to focus on that first one, subordinated debt. That phrase is everything, and we're going to unpack what it means in just a second. Because of that feature, you get a higher interest rate. That's your payment for taking on more risk. They're also usually long-term, and the bank might have the option to pay you back early. It's all part of the package. So this brings us to the most crucial concept of all, the payout order. Seriously, if you remember one thing, remember this. Picture this. A bank is in deep, deep trouble and might fail. Who gets their money back first? Well, it's not a free-for-all. There's a very specific line, a queue, and your spot in that line changes everything. Right at the very front of that line, the VIP section, if you will, you've got the depositors. That's anyone with a checking or savings account. And right there with them are the folks who hold the bank's regular senior bonds. They are first in line, no questions asked. Okay, so who's next? After all the safest people have been taken care of, that's where our Tier 2 bondholders show up, right smack in the middle. They only get a single penny after all the depositors and senior bondholders have been paid back in full. This middle-of-the-road spot is what defines them. And then, way at the back of the line, the very, very back, you find the stockholders. First, the preferred stockholders, and dead last, the common stockholders. As the owners of the bank, they take on the most risk, and they're the last ones to see any money, if there's anything left to give. So you might be asking, okay, why does my place in line matter so much? Well, it's simple. It directly connects to that classic investment principle, the balance between risk and reward. Your spot in the queue literally determines your potential paycheck. And this chart just lays it all out perfectly, doesn't it? Just look at the pattern here. As you move down the list, as your payout priority gets lower, what happens? The risk level goes up. And because you're taking on more risk, you get compensated with a higher potential return. And boom, right there in the middle, sitting in that sweet spot, that's our Tier 2 bond. Okay, but, and this is a huge but, here is the catch. This is the whole reason you get that higher interest rate. It's a feature called loss absorption. Let me paint a picture for you. Imagine a massive financial crisis hits. A big bank is on the brink of collapse. Regulators can actually step in and say, to save this bank, all of your Tier 2 bonds are now worth zero. Poof, your investment is gone. Or they could forcibly convert your bonds into the bank's stock, which at that point would be stock in a failing company. That is the fundamental risk you are taking on. So after hearing that, you're probably thinking, wow, that's a serious risk. And you're right. So if you're even thinking about this kind of investment, there are a few things you absolutely positively have to check first. Think of this as your homework. First up, you have to play detective. How healthy is the bank that's issuing the bond? You'll want to check its capital adequacy ratio. That's a key measure of its financial strength. And this is critical. Look at the bond's specific credit rating. It's almost always a notch or two lower than the bank's overall rating because of that payout risk. And finally, you have to be really honest with yourself. Can you stomach that kind of risk? This quote really nails it. It sums up the whole idea perfectly. These are not get-rich-quick assets. They're tools for people looking to generate steady income over many years. And, most importantly, for investors who have done their research and feel very confident in the long-term stability of the bank. So, that brings us to the big question, and this one is all for you. You've seen the payout queue, you get the risk versus reward trade-off, and you know about the big loss absorption catch. Now that you know all that, does this unique in-between investment have a place in your strategy?